let's get cracking here. We've got 45 minutes and lots to talk about. Thank you everyone for attending, and I think this is a perfect time to be talking about this. We are at a really important place in the market, and there are some really interesting things happening that I want to make you aware of today. We're going to be talking about smart money and the fact that we are seeing some serious cracks in the in this market from a smart money perspective. So we're going to be talking about obviously live markets. Standard disclaimer on the screen that these are not recommendations to buy or sell, but purely for educational purposes. So let's go through and go through the ride together. Essentially, what I want to take you through is a kind of a top-down way of looking at what the smart money is saying about the market now. So we're going to start out by looking at the top. They're looking at the smart money who had predicted the market's crashes before and what that's indicating. We're then going to go from people to systems and talk about what some of the indicators that have been between 80 and 90% accurate in predicting market direction are indicating, as well as crash indicators that have had that same track record in predicting market crashes. And are we getting another bubble? What are those all indicating? So and then we'll talk about how those relate to looking for the best trade setups in the market. So obviously if we go back to a simple principle in a top-down idea, Dow theory, which is one of the oldest theories in the stock market, suggests that a market obviously currently the price discounts everything. Now this is old news. This is what they were saying decades ago. Now price definitely discounts everything. Over 70% of the quote-unquote people that read the NASDAQ newsfeed are not even people anymore. They're algorithms that digest words, put them into computers, react to them. To compete with information and news and try and be ahead of the market and have an edge is impossible. And therefore, we start to look for how do we get an edge. Well, and to determining where the market is at. Obviously, there's three key stages that the market goes through. An accumulation zone where the smart money is loading up, and usually most people are selling. Then accumulation zone changes into public participation, which is where everyone else jumps in. And then you go from that into distribution zone, where the smart money says, right, this is getting toppy, time that we start selling off. And that's the worst time to buy, of course, and obviously the time that they want to lure you in the most so that there is someone to sell to. So obviously, as a trader, as an investor, whatever you are, you need to be able to determine when how to determine when the shift from one zone to the next is occurring. And where are we at right now? Obviously, right now we have big threats in the market. We've obviously seen the overseas economies having some big problems. We've seen plunging oil prices, which has obviously affected a lot of the Midwestern banks and other people that rely on oil prices to be successful, to not go bankrupt. We may very well be headed towards $40 oil again. We've been very bearish on oil since $50 when it broke down out of its upward channel. It's been a wonderful short, but there's a lot of threats, and I'm not a fundamentalist. I'm not an economist. That's not the area that I'm interested in. But whatever the domino is that falls first, it doesn't really matter. You don't need to predict what exactly is going to cause the stack of cards to fall to understand how to trade it. But there is big risks, and when these risks hit, you get contraction, you get people fleeing the market because they're no longer willing to say, I'm willing to load up here, and when people look at the market right now and think, gee, I've got all my IRA in there, my 401k, my retirement savings, loaded up in these different places, when is the time to sell? And you simply ask yourself the question, looking at the market today, as a trader, you should be thinking about risk reward, obviously in all situations. How much do I stand to make versus how much I stand to lose? If this was a trade setup right now, and you look at the market and say, well, how much more upside is there versus how much more potential downside could there be? And some people say, well, there might be another 5% upside left in the market before we top out. Sure, maybe there is, but how much downside is there right now? I mean, we could be looking anywhere from a 10 to 20% or possibly worse pullback. So from a risk reward standpoint, from a long-term investment standpoint, we're at really dangerous levels where I think the risks significantly outweigh the rewards of being heavily long. So these are the kind of, I don't know how many people agree in the audience, but that's the way that I look at something. What's the risk versus reward, upside versus downside? And people are seeing that. We are seeing big flows of money out of the market, and we've actually been seeing it since early last year. In fact, in March of last year, there was over $1 trillion short the S&P, which is the highest level since 2008. We also saw the longest and largest exodus of the stock market since 2008 throughout last year as well. All the time the market was building. So money has been going out consistently, and most analysts, most smart money people explain this as a melt up. A lot of very bright theories that I've been following and reading about recently suggest that you normally get about an 18-month melt up before a big melt down. Now, early last year, when we had these massive sell indications, which I think many of you probably have been seeing for a while, if you think about from there till now, how long that has been, it's been exactly 18 months. So we're now at some critical levels, and people are flocking out. An article from Annie Novi from time.com talked about the fact that one measure of optimism is fund flows, which shows basically investors, which is largely consisted of middle-class American retirement savers, in March, excuse me, in May, pulled out more than $2 billion net in domestic mutual funds and ETFs. So people are already seeing there's not more reward than risk, and starting to be very careful with where their money is put. So let's have a look at as we survey these risks. Let's go and let's check in with the smart money individuals who banked big time on the 2008 crash, because that's what we should be looking at, is what did we learn from the past, and how does it relate to now? I'm sure there's many of you in the room that would have loved a big warning in December of 07 saying this is what's happening, you should really be careful, because I'm sure most people here know someone or were directly impacted by the 2008 crash badly. How many people here would agree with that? How many people got a bit of a massive shock or were hurt by the 08 crash? And if that's you, we say, how could have we predicted that, and what do we learn from that as it applies to today? So Tim Forrester was one of the blokes that made money, and he's the gentleman from Chief Investment Officer from Forrester Capital. Predicted the 08 crash, sold enough of his fund's bank stocks to reduce the fund's holdings to 5%, which is a lot because the finances made up 20% of the market at the time. And he was highlighted as one of the only funds that's long only that made money in 2008. His comment was that the last two crashes were sparked by one industry's failure, which was tech in 2000 and housing in 2008. This go round, he fears almost every sector has become overvalued, with 9 out of 10 sectors more expensive than their 10-year average. So that's one thing to look at. Jim Rogers, the next gentleman, he's a very interesting man to follow, and his comment is it's going to collapse. He shorted Wall Street months before the 08 crash, and he's quoted as saying, some stocks in America are turning into a bubble. The bubble is going to come and then it's going to collapse. You should be very worried. How big a crash could we be looking at? He was asked by this Henry Blodgett, And his response was, "It's going to be the biggest in my lifetime," the 74-year-old investor said. And Mark Faber. Now, and with this being said, he does write the gloom, doom, and boom report. So he is bearish by nature, but he's got a lot of interesting points as to why he is. And he believes that asset holders are going to lose at least 50% or possibly get wiped out completely in the short to medium term here. And he talks about the fact about the leverage. You know, there's more stocks today purchased with borrowed money than since the 1950s. So basically we're dealing in 67 years. We've never had so much borrowing, so much paper in the market, and the market that we're borrowing all this money to buy, yes, has been driven up as a result because money's been cheap and people have been able to borrow money to go and do that easily. But the gains that we've actually seen in the market as to whether this is real growth or just a bubble, if you look at what's made up the S&P's growth last year, 5 companies accounted for almost a third of the S&P's gains. That's not good. And these kinds of bubbles, if we look back to learn from, let's go back to the tech crash of 2000, 2001. Right at the peak of that market in 1999, if we compare the data now in the market versus what happened in '99, we can see that consumer confidence has rallied up and has peaked to almost the exact same levels. If we have a look at business confidence, we've actually seen that the charts look very much the same as well, but in fact now the confidence is even higher than before the crash. And you know what they say? They say when optimism is at its highest, the seeds of the next crash are being sown. And we don't need to know what that is. We need to be aware of what the data is telling us, because by the time you know what that domino is to fall, it's already too late. And as traders, we should be anticipating the market rather than reacting to it. The next thing that he pointed out, as Brad McMillan pointed out, was job growth. We can see that job growth boomed just like it did prior to the tech crash. We didn't actually go as high as we did before the tech crash, but we've been tapering off ever since. So, and last but not least, the comment he makes is that the economy might be even more inflated by monetary policy than it even was in '99, because and if you have a look at the yield, we are at higher levels than where we were before the tech crash. So those are a couple of things coming from smart money that that I think are quite interesting. So if we go from the spoken word and looking at the kind of fundamental data, let's break that down from that top-down approach to look into the next level of data. Okay, so this is a chart of the smart money, well, basically the insiders buy and sell ratio. So this actually shows you how many people that are considered, the people that know what's going on with the economy. They know whether they're selling more iPhones than not. They know whether they're shipping more dry bulk or not. They know this stuff. They are the inside, and what we've seen is sharp divergences in the opposite direction. If I bring this to an updated chart as of today, you'll actually see again that we can have, since the middle of June, when I took that snapshot, we came back to some complacency, and we've now sharply diverged once more. So we're getting these really sharp upshots away from the buy side and strongly to the sell side. So these ratios are extreme levels and approaching even higher. So that this goes to show that the people that know the economy best from seeing what's happening within these Fortune 500 companies are not buyers of the market, they're sellers. And if you go in to break that down by sector, you will see that same chart and same type of sell signal is there. The reason why you can't see any blue on this chart is because there is barely any. There, you should see blue bars representing insider buying over the last 90 days. There isn't any, you know, that's my point. Over the last 30 days, you know. So, I mean, one of the things that you may notice is the basic materials over the last 3 months and a lot of these resource stocks have been getting pounded. And that was a great signal, for example, to go in and say, well, you know, where is the money flooding out of? Well, they were flooding out of, a lot of them were flooding out of gold companies, a lot of smart money selling in gold companies. And this was one of the reasons when everyone was bullish on gold, and we looked back at these charts in April and May, and we said, I don't think so. Regardless of opinion of why gold may go up, if we actually look at the smart money, we can see that we have a very clear head and shoulders pattern here. And so GLD and gold has been an excellent short, not a good long, and from 122 down. In fact, just recently, as we approach this neckline head and shoulder, this was in fact one of the alerts we sent out, was to look at the 116 puts on GLD, and we could very easily get all the way down to 110 here in the next few weeks. Not only did the chart indicate this incredible bearishness, but the smart money did as well. And then we take the insiders, we take the chart pattern, and then we look at the actual this indicator, which is critical to our decision making, which is called Twiggs money flow, or the smart money indicator we call it. And this is an algorithm that looks for smart money. It looks for how the stock's closing. It looks for the volume that's coming with the stock. It looks at about 6 different factors, the true average, true range, all these things, and combines it into one indicator, which very accurately figures out if the high frequency trading and so forth are loading up or selling to you. So when this breaks down, that's another really key signal. And as you can see, that happened right there. And it hadn't been that low in quite a while. So again, you can see how this starts to work. So I mentioned the word systems, and that is really what trading is about, isn't it? You know, when I talk to, you know, we've been doing this now, Acorn's been around for 10 years this November, and when I talk to the students we work with, because we do a lot of one-on-one training and with all of our clients, and when I talk to students and say, you know, what's the number one thing you're looking for in trading? A word that comes out a lot is consistency. That they are sick of waking up every day and going to battle with the market, sick of waking up every day and having to look at 15 different indicators and overcomplicated charts to figure out what to buy and sell. And half the time, they add more confusion than they do help. So consistency in profits, consistency in strategy, and simplicity in how we go about it. So to do that, let's look at what the systems are saying instead of opinions. So the first of which I want to show you is one that is incredibly valuable. It is something I'm going to share with you today. It's called open range. Now, this is a technique that predicts the S&P 500's direction for 2 to as much as 3 weeks in advance, and back tested over the last 6 years, it's between 80 and 90% probable, successful in predicting the S&P's direction. So you can imagine how valuable that is. You've got analysts. If you look at the statistics on analysts, because there was a show called The Theory of Experts, where they looked at the talking heads on TV and followed all of their picks and alerts and economic theories, and almost all of them were wrong. I think it's something like 80% of their suggestions didn't make money, or more importantly, lost money, and their theories were almost all wrong. So when the odds are stacked against you to listen to the experts, where do you go? Well, let's go back to the systems that do have a track record, and this is one of them. And the way that open range works, this is something that takes me really about an hour to teach properly, but let me give you the broad strokes. The way that the open range works is it's 2 specific days in the year. And what you're looking for is the first day, first trading day of the month, which let me just, we'll come back to this chart later because it's very interesting. Well, I'm just going to delete the lines. So let's look at the first day. There's June 1st, Thursday, June 1st. Okay, there and there. That's the range of the first trading day of the month. Now, what we're then waiting for is after the first trading day of the month has printed, we're looking to see if it closes above or below the range. Now, there are some rules to this as to how many points it needs to close and things like that, but the simple explanation is, do we go higher or lower after that's printed? The very next day, on June 2nd, we go higher. That means to 80–90% degree of probability that we are going to close within this range or above it between now, by the next time open range comes about. And the next day is the third Friday. So the first day and options expiration Friday. So that means that by options expiration Friday, so in other words, the Thursday before it, the market should close within this range or above. This is incredibly valuable because now it tells you what type of bias you should have for your trades. Are we looking for, for the next 3 weeks, looking for longs, shorts, and so forth. As you can see, that that transpired beautifully, and as you can see, closed on Thursday, June 15th. I believe that was the options expiration, wasn't it? Yep, 16th. Closed right there in the range. All right, then we went higher. Okay, so there we had a new open range on Friday, June 16th. The market closed above, and that tells us that at the end of the month, June 31st, the market's going to close within this range or above. Let's fast forward to that day. Of course, that was right there. Friday, June 30th, and that's exactly where it closed, right in that range, right there. And that is exactly, in my opinion, what drove it back up from 2,400 after that crash. And that's an important one. We'll analyze it in a moment. What drove it back up was, again, open range said, this is where it should close. And this is basically the unspoken language of the market makers talking to one another. These are the rules within which they make the decisions, and therefore incredibly important to understand. So that's open range. Any questions on that? Pretty fascinating stuff, right? So there's a lot more to it, and if you do want to learn more about that, we do have a lesson on this. As I said, it's about 45 minutes long, and we do offer that for purchase for $197. But as a special gift to everyone today, you can have it for free, and this will give you a very quick shot of exactly what you need to know about it, how many points, what types of patterns to watch, and then it goes through all the back testing data and shows you, over 6 years, all the entry and exit signals and how well it works, so that you have that instant confidence in going forward. So I'll put the number here in the chat box because we're short on time, so we can't chat too much more about that. But all you need to do is just text money to 604-227 4463, and I'll pop that in the chat box for you all. All right. And that will go to our automated system, and it'll get that email out to you today. So let's move on. Let's go from the systems to the charts. The charts are showing us a very similar story. So we're kind of breaking it down again, top down, to now look at what type of setups we're seeing. And this is the VIX. And if you look at the VIX all the way back to 1991, we are at levels that we have never broken below, right? So if you want to think about peak confidence and dangerous levels of optimism, when we talk about the VIX, we talk about it in terms of complacency. How complacent have people gotten? And the VIX shows us that we're at all-time lows of volatility, meaning complacency. And I asked, this is a webinar, this is a shot from the webinar we did back in June 28th on this similar topic. And I said, look, if this was a trade, if you could buy this right now at $10, and you know it's never gone below where you're buying it now, but over the course of a month or a few months, it's 100% of the time gone up, at least 100%. How does that sound as a trade setup? Sounds like an excellent one, doesn't it? And and that's exactly what we've seen from when I took the screenshot and made that comment. As you can see, the VIX already back on June 29th, the day after this last presentation we did, the VIX spiked from 10 to 15, 50% move. That's the type of thing we're seeing, and it's etching further up. So the charts are showing a similar story. And if we go back and have a look now at a couple of other charts I want you to be aware of, we start to get into things like checking out this MMFI. This is an indicator which I think I want you to be aware of, because a lot of people talk about what's the market doing today, and obviously people say, well, the S&P is up this and the blah blah blah. Well, that's really not what the market's doing. That's what the heavily weighted stocks in the market are doing. As we said, the stocks, five stocks, represented a third of the market movement back in 2016. So, but the market is not a market. It is a market of individual stocks, and that's what we should be focused on. As a trader, I don't care what the market's really doing. What I want, what's going to make me money or not, is if I can find the best stock to buy or short, and that might have nothing to do with what the market's doing. In fact, that, in my opinion, a good trader should be able to make money shorting only in a long market. A good trader, a good strategy, should be able to still make money going long in a bearish market, because that's where you get your strategy. It's the fact that the stock has performance regardless of being following the S&P. We don't want those. This shows you the representation of the stocks in the market and where they're at respective to their 50-day moving average. Have a look at what's happened here. This is a percentage. So in January 2017, beginning of the year, 80% of stocks were above their 50-day moving average. Since then, that has significantly declined and is making lower highs and lower highs. As you can see, we've had this rally back up just recently, and we formed this beautiful upward channel and tested that from beneath and have now plummeted. We've gone down from 63% of stocks above their moving average to 55. In fact, a low of 50 yesterday. If we look at one more smart money chart, high yield bonds, you'll actually see the same thing. If we look at high yield bonds as an indicator, because this is basically where the smart money is buying corporate debt. In other words, they like the risk of the market. They think everything's ho-hum. Let's load up on risky assets. Then this should be going up. If they are saying no, no, thank you, get me out of this market, this should be going down. Now, as the market was going higher, both the stocks in the market were diverging, as well as corporate high yield bonds. And again, broke down from this channel, retested, and has once more broken down. So these are now both of these indicators, the stocks above their 50-day, as well as high yield bonds, have died. If you go back over the last 20 years and look at every time the market has crashed, these have always been a leading, unless I'm missing something from my research, they have always been a leading indicator before a correction of at least 10% or an all-out crash. And whether it's a correction or a crash doesn't matter. You don't know until later. You can't say, oh, this will only be a 10% correction and not a crash, because you don't know that until it turns into a crash. You've got to be able to anticipate that at the beginning. And if it bottoms out at 10%, take your profit. Doesn't turn into a crash, so what? You've still made a ton of money shorting in that first leg down. You know, so it really doesn't matter whether it's a correction or a crash. You still approach it the same way. In my opinion, anyway. So these are what the smart money indicators are showing. This is what the systems are showing. Now let's look at what the actual market's doing. Is everyone with me so far? Hopefully I'm not getting too technical, but that's what we're here for. So let's look at the S&P 500 now, and I'm just going to take all these moving averages off. We don't really need them. Let's keep it nice and clean. First and foremost, let's look at the different time frames. On the S&P 500, we are arguably in an upward neckline head and shoulder. Now, if you look at all of the crashes in all the major corrections in the last 10 years or longer, we can go back all the way to 99. Have a look at this. Let's go back to 99. And what you'll see here, let's make it a little bit longer. So 99 into 2000, what you can see here is that the way that the market topped was a head and shoulders. It was an upward neckline, head and shoulders. That was the key signal that the market was crashing, and that began building in 99. That head and shoulders began, the crash started in 99. That's when the head and shoulders was written in stone and the smart money was gearing up to get the hell out. Let's fast forward. 2004, upward channel. Upward channel should break down. It didn't, it went higher and formed a head and shoulders, as you can see there. Broke down to exactly where the head and shoulders said it should, formed another head and shoulders there, broke down to exactly where it said it should, and then created an inverse head and shoulder at the bottom and rallied back up exactly to where that said it should. So the chaos of 2008 wasn't really chaos at all. It was technical patterns and indicators that gave you a very strong sell signal. And if you look at that smart money indicator I was telling you about earlier, the whole time that market was going higher and creating that very bearish top, the smart money was saying, get out, because they were getting out. It was the people that got crushed, not the smart money. And if we fast forward to how that relates to today, we had another long up channel, like in the 08 build up. We then dropped. There's the channel, broke down to exactly where it should, based on the channel rules, created a downward channel. So then you measure the channel, broke up to exactly where it should, 2300, and has now formed something else. So what have we formed? What's the pattern now? Because the pattern is very important to understand. If you look at where we're at now, you will see that we've had a left shoulder, up, hugged the line, went up, down, hugged the line, and we have this perfect symmetry now of how the head is built, which is important when you're recognizing this pattern. There's the left, there's the that dropped, hugged the line, there's the right contact point. beautiful symmetry, which indicates we're now right around the time, either now or in the next few weeks, for a sell-off to come. And as you can see, the smart money diverging. If we then take this and look at what occurred, obviously, on Monday, open range. First trading day of the month, open range is being printed. So there's the high, and there's the low. Open range broke down yesterday, and that is the first bearish signal. Okay, that indicates weakness. And then if we go to the hourly chart, you're going to see some even more fascinating stuff. If we go to the hourly chart, let's delete some of this noise. I love to keep my charts as clean as possible, but when I change time frames, it puts everything back on again. So if we have a look at the market, you'll see that we have been in this upward channel. Bang, 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 bang. Again, upward channels are bearish. And then what occurred is we built a head and shoulders here. All right. And that means, measure, that we're dropping from the breakout point, which is there, meaning a target of 24.10. Look at where the market went. Bang on. We also have an upward channel we're breaking down from. So we measure from that breakdown point. That also suggests a target of 24.05. Look at where we dropped to. And then just in the last few days, we had another plummet. Another little head and shoulders here, right? And that dictated a drop to 24.10, and look at where we went. This market is moving perfectly. I mean, since June 20th, we've predicted every major turning point in the S&P 500 and where it would close due to the open range signals and the head and shoulder patterns. So crystal ball, it's just using rules, the same stuff you can do yourself. You know, so we're not doing anything magical here. It's written right here in the chart. And last but not least, before we move on, I want to also show you what's appearing in the NASDAQ, because that's been the strongest part of the entire economy, has been the NASDAQ surge and all the tech stocks, right? And if you look at that, there you go. The NASDAQ itself is forming a head and shoulder and is actually already broke down from it. So what is this? So how do we then approach this? Well, see, normally I'm a pretty happy-go-lucky type of trader. You know, I'm a very technical guy, and as long as the technicals are there in the pattern, you know, I'll trade it. But now in this market, it is very important, and what I found the most successful trade setups have been is looking for really needing the perfect storm. So when I'm looking for a short, you know, I want the company to be highly in debt with no equity. I want them to be overpriced by, you know, 50, 60, 70, 80 times overpriced based on the amount of cash flow they actually have to run their business. I want to see that they're in a sector that all of the institutions are selling hard, or an industry that the institutions and insiders are selling hard. And I want to see that the insiders themselves have been flooding out and getting out of the stock. I want to see that all these fundamentals are weak. These are the rotten apples. And then I want to add the technicals on top of it to say, okay, and when are these rotten apples ready to drop from the tree? Because that's when timing is critical, to make sure you get in at the right time and out at the right time. So this is what you want to what you want to look at. So what is your strategy? most investors don't have one. I mean, when markets get turbulent, they get scared. And that is what, this is the best time to start really defining what you're looking for, and searching out these high probability trades. So scanning is now becoming critical because we want to look for all of these potential factors. And what we'll be inviting you to here, and we've only got a couple of minutes left, so if you have any questions, please let me know. If you're the course that we're going to be launching here is starting on Monday, is going to be focused on how we capture this crash and how we scan for these opportunities. It is two-hour lessons, one on Monday night, one on Wednesday, and what we're going to be going through is the complete process of how from start through finish you build a strategy around trading this market. The first part, okay, how do we set up our trading day or week, start through finish, to determine the market direction, where the smart money is going, and therefore what types of trades to run, to scan for. Sets you up with the smart money indicators that I've shown you today, so that you have them at your disposal so you can instantly see where the money's going. The next step is then, now we know where the market's at, what the indicators are telling us, and where the best trades are. Now we know which scan to run. And what we'll be doing is teaching you three: the smart money insider scan going long, the smart money insider scan going short, and the short squeeze scan. So we cover all kind of areas of the market: long, short, and reversals. And that's basically all you need. If you can do those three things well and master those three scans, you're in a perfect position. So that's what we go through for you. And on top of that, we'll also be giving you access to our favorite trade setups that are ready right now. And these are absolutely awesome. We've got 1 minute left here, so I'll just share with you the most recent ones so you can kind of see what I mean. So there we go. Here's MKC. This was found with a smart money short scan. Again, this is actually taught in the scanning class, and you'll receive the recordings of these previous lessons so that you can study up before the live classes next week if you like. This was an upward channel. It was found instantly using our smart money scan. You can see the smart money indicator was selling off. We had a beautiful bearish pattern. It broke down through 100, so we alerted our students to the $105 July puts, and they were up about 150% 4 days later. That was an easy setup, and easy for you to understand how to pick it yourself. If you actually have a look at the insider selling, you'll see that it was obvious. The directors were selling 54% of the 24%, 54%, 40%, 97%, 86% of their stock that they held in their own company. Yeah, I would get out of the way of that. And that's exactly what you'll learn in this course. So that's my time up for now. And of course, the link there is acornwealthcorp.com/smart. And if you have any questions at all, my email address is in the chat box that you can email us at.